Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host, and we are coming to you live at 5 p.m. as we typically do on a Wednesday. Today is October 29th, 2025, and we've got Halloween right around the corner. And instead of a trick, we're giving you a treat. We've got Mark Minervini on the show coming back. Mark Minervini, of course, two-time U.S. investing champion, author of Trade Like a Stock Market Wizard, Think and Trade Like a Champion. Gosh, what am I missing? The mindset. What is the mindset one? Mark, help me out.
Mindset Secrets for Winning.
Mindset Secrets for Winning. So yeah, there's just so many books that are so great. And then of course he's the founder of Minervini Private Access. Welcome back to the show, Mark.
Hey, thanks for having me.
Absolutely. Let's get right into it. We just had a Fed meeting. Everyone was expecting the quarter rate point cut, and I guess the thing that people are trying to get a handle on is what this does to December. Let's talk a little bit about, again, I know you have all this experience and all this macroeconomic analysis that you do, but a lot of times you've said, well, gosh, it really depends on what the market does. What does the chart say? So tell us a little bit about how you're viewing the current rate cut situation.
Yeah, I mean, over the years, I've been pretty good at reading the overall market based on macroeconomics and actually timing the overall market as far as the general market. I've been short most bear markets, or at least been completely out and missed getting any damage. But when it really comes down to it, that's really not what guided me into those situations. It almost always is just the individual stocks. That's, as a matter of fact, sometimes those macro tea leaves or the general market itself will look quite healthy when beneath the surface you're seeing a deterioration, and it takes time for that to actually end up showing up in the indexes, which in this particular instance, it's very much that case through pretty much the entire bull market. I've called this a reverse stealth bull market.
Right. Uh-huh.
Yeah, where you've got the indexes are moving higher and higher, but there's really not much participation. We talked about, the concentration in the market is just getting more and more concentrated.
Yeah. And, one of the things just at least recently to kind of really kind of hammer that point home is I'm going to show SPY right now, the S&P 500 ETF, and even some of these days that were very strong for SPY, when you looked at RSP, which is the equal weighted S&P 500, it was kind of a different picture, even today, closing below the 50-day moving average line. So it's like your average S&P 500 stock is still in this sideways action, even though SPY is bolting to new highs. So what do you use as kind of your breadth indicators?
I shorted the SPY today, so I'm actually short right now, but I have a very tight stop. I've shorted it maybe 3 or 4 times throughout the year and been wrong pretty much every time. One time I was right for about a 5% move. It wasn't much of a move, but even now, I'm expecting maybe a normal pullback, maybe one that's been a little bit bigger than we've seen. But if you compare that to the average stock, that breakout names, and you start looking even broader base, not just 500 names unweighted, you're comparing it to itself, just unweighted. It's a much more grim picture as far as the underperformance. But you can see the RS line plunging to new lows recently there. So again, the weighting of the indexes. You've got 10 names that account for 40% of the entire index. You have the same type of situation in the Nasdaq too, where you've got just a handful of names account for a big portion of the market cap. This is akin to the Nifty 50. I pointed this out recently, but if you don't know what the Nifty 50 is, most viewers are probably too young and that weren't in the market. But it even goes back before I was in the market. I started trading in 1983. Nifty 50 goes back even before that. Look it up. Go to Google Nifty 50. This is a very much a Nifty 50 type market where the money's chasing a small number of names. Now, the argument is there's a very good reason for that, and that is that we've got a monopoly right now with these companies that hasn't existed since you can go back to maybe the rails and the oils and the Carnegies and Rockefeller, Google, Apple, Amazon, Netflix, Nvidia even, these companies have an incredible competitive advantage, and quite frankly, the regulators, the government doesn't know what to make of this. These industries it's like the Wild West, and they just have the run of the joint, and they just buy everybody up. They've got so much cash, and it's a real, go back again, if you go way back to Ma Bell, AT&T, and how they broke up the phone company because it was a monopoly. These companies would have been broken up a long time ago, I think, if
Yeah.
people really the regulators really understood the businesses. But again, that's not for me to decide.
Yeah, and sometimes it's tough for the regulators to keep up with all the innovation that's happening with all these companies.
I've said this before. When Zuckerberg went to testify in front of Congress, the congressman looked at him and said, I don't understand. Can you tell me how does Facebook make money? And Zuckerberg was like, advertising? Like they didn't even understand that part of it, let alone deep into technology and now AI and all these other things that have decades of runway, and implications.
Yeah, no, absolutely. And, a little bit earlier, I did show FNGS, which is the Microsectors FANG Plus. Whether you look at that, the MAGs, the Round Hill Magnificent 7, to your point, these have a very different look. Again, these were all closing near their highs today and have been, almost gapping up each day. Whereas, again, when we look at the average S&P 500 stock, very, very different picture. The advanced decline lines. There's all these other breadth indicators that are not showing such a rosy picture. Do you have a favorite for yourself? What gives you that sense of breadth, or are you just looking at a lot of charts and saying, I'm noticing that there's a pattern here?
My main read is from the individual charts, of going through the charts each day and looking at the stocks that are setting up in bases, if there's a lot of setups, and how well the setups are working. You could still have a lot of setups, but they don't necessarily have to be working from the breakout levels. And also, in this particular market, you've got many that work, but there's a lot of volatility around the buy point. So getting in on a low risk entry is difficult to stay on board. I often say, your goal is to get from one side of the corral to the other, and you jump on a horse, but he bucks you off 3 steps in, and the horse makes it to the other side of the corral. Well, that doesn't do you any good, because you need to be on the horse. So the horse might get there, but if the risk is too much and it throws you, and you get stopped out of the position, now you could say, well, don't use stops. Well, now, when the horse runs the other way, you're stuck on there as it's galloping the other way, and you got to leap off the horse and break your neck, right? So you have to manage risk. So the market doesn't have to just be where things are working or they're not working. There's some gray shades in between, and I think this particular market has been one of the more tricky ones as far as getting in on some of these opportunities, but keeping the risk low.
Mm-hmm. Well, and I want to get back to something that you mentioned earlier. It might surprise people when you said that you're short SPY right here, but I think this is a good,
but I have a sub 2% stop. So.
Right. I was going to say,
Yeah.
This is a good time for you to talk about that whole managing risk and how you can go into something, and as you said, you can be wrong a number of times, but if you're keeping your risks small, you're not going to get hurt.
Yeah, the 3 or 4 times that I've shorted this year, and if you added up all the losses, I don't think they even add to 5%. Mm-hmm. With this one, maybe it'll be 5-6% or so if I got stopped out on this one. So I'm trying to time it like really to the day. If you're going to short a freight train, you got to do it from very low risk. You can't allow it to run over you and drag you down the tracks. You have to do it where you have to realize, okay, if I get this wrong, I move on, I try again. And the reason why you keep the stops really tight is so you can have multiple tries. Then when you finally get it right, even if you're stopped out 3, 4, I've been knocked out 4 or 5 times trying to get the market top right. And then when I got it, it paid for all those times in just a couple days, and then I'm in a really good position. So yeah, it's all about losing the least amount possible and just waiting to be right.
So you mentioned how you're kind of starting with a smaller position. So of course your portfolio risk, even if you take, let's say, a 5% loss, if it's a small position, the risk to your portfolio is just
Well, I actually don't
minimal.
take small positions. I'm going to correct that one.
Oh, okay, okay.
No, I didn't
So,
say that.
oh,
Yeah,
okay. I
I'm not
misunderstood.
one to take small positions. I usually
No,
take
no,
very
no, on the
large
shorting
positions.
side, for the
I
short
take
SPY.
huge positions when
Oh,
I
okay.
short. Yeah, I'm usually going in very large, but that's the reason why I keep the stops really tight. So I want to get paid when I'm right.
Yeah.
Okay, so if I'm right, I want to be in big, but I don't being that means I have a lot of exposure and I have a lot of risk, right? So I don't have much overnight risk with an SPY. So I can go big with that because it's not going to gap up tomorrow 20%, like a stock might, and maybe even much more. So I'm willing to go really large. If the names are liquid, but the way I manage the risk is, of course, it's going to be with keeping the stops tight, and I'm going to be admitting defeat very quickly,
Right.
and
No.
then and trying to retime it again, as opposed to just hanging in there and taking a big loss.
Well, one of the questions that came from Paul on our YouTube, and again, thanks Paul for putting the question in. I'm gonna throw some of these at you, Mark, because I know you
Sure.
can handle it.
Yeah, I love them.
So he's talking about a stage 3 top, and of course this is probably you've mentioned Stan Weinstein a lot of times in your um, someone that you know very well. I had the pleasure of meeting him when for your birthday event,
Stan is a
and
very close friend of mine.
yeah.
Yeah.
So, is this something that you would consider a stage 3 top, or are you doing that level of analysis here on the indexes right
I
now?
don't think we have a stage 3 top formed yet. I don't see that. With the indexes, I'm not treating them like a stock. A stock, I would be waiting for a stage 3 top and maybe even get into stage 4 and really have the stock break and maybe trade under the 200-day moving average. With the indexes, I'm trying to trade them right off the highs. Like usually they'll be hitting all-time highs, and then there'll be a reversal or a distribution day coming off the highs, and I'm coming right in off the highs. So I'm actually shorting the indexes when they're the strongest sometimes, and everybody, especially when everybody's bullish, and you got the sentiment really really high as far as bullishness is concerned. Now that's what we don't have right now.
Yeah.
It seems like everybody's trying to pick a top in this market. And I hear a lot of people talking about bubbles and AI bubbles, and I've been talking about that too. I'm talking about it in a longer term time frame as opposed to being right now. I don't think that's in place just yet, but I think we're in the making of a potential bubble. If we don't have a good correction, we don't correct it, we keep going higher, and then everyone throws in the towel and you get that bullishness, that's where I would start talking about the bubble. But usually when there's a bubble, everybody's not talking about a bubble.
Yeah.
That's part of the definition of a bubble is nobody thinks it's a bubble.
Right.
So that's why I have to be careful with that. Plus here we've got they say the trend is your friend, the Fed is your friend, right? We've got both. The trend is very strong. We have a long-term model, SPY model, that's fully 100% right now allocation. It went bullish on May 8th, 100% into the SPY. There's no signs of that right now showing any raising any cash. So the trend is very strong. Long-term trend is up, and you've got a Fed that's bringing rates down in a non-recessionary environment, which is the strongest scenario. And the fact that the Fed only has to bring rates down, some people are worried that they'll only bring them down little increments, like that's not going to be bullish. Yes, actually it is very bullish, because if they had to bring them down in big increments, well, that would mean that, because they're usually late, that means the economy's in trouble, we're looking at recession, and they may have missed the mark. This shows that we're in that Goldilocks situation where not too warm, not too cold, and they're just making minor adjustments, and the economy's ticking along. That's an environment that a bull market can continue. You can continue to have a secular bull market. Corrections are cyclical, and the 12 months after the Fed starts bringing rates down in a non-recessionary environment are historically very strong.
So yeah, as we talk about the Fed, again, there was no real surprise here in terms of the cut. Of course, there is this balancing act between inflation and unemployment, and it seemed like it was the bigger concern right now is a little bit more on the labor market, potential weakness there, as opposed to inflation. So,
Yeah.
does that factor in at all for you?
The
Or
market moves, the market historically moves inverse to the unemployment rate. So when the unemployment rate starts going up, market goes down, and vice versa. COVID, and a lot of analysts feel this way, that COVID distorted some things. I think enough time has gone by where those distortions have worked their way out, worked their way through mostly. Everybody said Trump's tariffs were going to cause inflation. They haven't. They haven't. And now rates are coming down, and you've got the Trump tariff situation, and inflation's not taking off. So that just goes to show you that inflation is not that big of a problem right now. And there's a lot of money sloshing around there. I know there's always poor people, there's always rich people, and there's always someone who's going to say it's not good or it's good. But on average right now, people are doing. My friend just went on a cruise. Said he never saw so many people playing the high dollar slots, and you just see, you go to malls. I was just at a mall, lines out of Louis Vuitton, and these aren't wealthy people. These are normal everyday people, pretty much everyday people. That are, brands are bigger than ever now, and I don't see the recession, the depression, the type of environment that some people are concerned with right now.
Mhm. Yeah, no, that makes
Not yet,
sense.
at least. Not yet, at least.
Well, and getting back to your point, there is that sentiment, that sentiment side of things, because you mentioned very accurately how there is still a lot of fear in this market. So here we are at
There
all-time
is.
highs, breaking out into all-time highs this week, and there's still this huge fear sentiment. So,
Yeah,
what are you
a lot of
using
people
as your
are trying
sentiment
to pick a
indicators?
top here, I think, and
Hmm.
that's why I'm careful. I am also, shorting every now and then, trying to catch maybe the high, but I think it would be a cyclical correction. And I don't think we have a secular bear market in the making, and I don't think a major bear market is in the making just yet.
Hmm.
But
What
you
are
were
you
saying,
using? What are you
yeah, go ahead.
using as your sentiment indicator, though?
So we follow a whole bunch of stuff. I mean, I use Ned Davis Research, and they've been providing a host of readings and all kinds of tea leaves for decades
Hmm.
for me.
Hmm.
They calculate a lot of the models that we watch. So we watch there's like 40 sentiment indicators, but I really watch like three or four carefully. Um, Investors Intelligence is probably one of the best reads of
Hmm.
newsletter, opinion. AAII, American Association of Individual Investors. That's one right now that actually, um, yeah, it's, if you look at it, it's come off the highs. Now, sometimes the sentiment is right in the beginning when things turn. This has happened a few times in the last maybe 5 or 10 years, where before you topped, sentiment actually turned down ahead of time. So you really, you can't just not you can't just trust sentiment. Sentiment just gives you sort of a temperature of the market, and just like a PE ratio. You can't sell a stock because it has a high PE ratio. I bought Yahoo in 1997 at 908 times earnings, and the stock went up 8,000% in the next few years. So I bought stocks that were trading at 1,500 times earnings, and they went up tenfold.
Right.
And then there's stocks that trade at 10 times earnings, and they went to zero. So, it just tells you the temperature. It tells you the expectation. High PE tells you there's something going on and there's a high expectation. Low PE, there's a low expectation. And high PEs are usually due to bull markets, and low PEs to bear markets.
Hmm. Yeah, no, absolutely. Bill O'Neill, founder of Investors Business Daily, used to talk about, look, if you want a Michael Jordan on your team, he's going to have a high PE ratio. It's
You have to
just
pay for
right,
it.
exactly. Yeah, you don't get value, with some of those top players. I suppose I shouldn't use an old basketball analogy when we're in the middle of a World Series, but there it is.
Yeah, Palantir, these companies, Nvidia. I mean, Nvidia looked overvalued so many times, where
Mhm.
not only was the PE high, but it had expanded, where you got PE expansion, where it doubled and tripled. And I thought, well, it might be over because of that. Then the stock rebased, broke out again, earnings came through, and the PE works itself out. If the earnings keep coming in and growing really strong, if the earnings are growing really strong, you'd be surprised how fast a company that has a big high valuation gets down to a more moderate valuation.
Hmm.
That happened, with Cisco. Cisco had 12 or I think it was 16 quarters of triple-digit earnings. I always tell people, take whatever your business is. Let's say you're a plumber and you do $700,000 a year. Take double your revenue and your earnings every 3 months and see where your company would be just in 2 years. You'd be a multi-hundred million, if not a $1 billion corporation. So that's the power of that compounding. If you grow your earnings at that rate, the PE doesn't really matter. That's why you want to gravitate. That was O'Neill's argument, and not just an argument from his opinion, from facts,
Right.
where if you stick with very high growing companies, even the CEO himself doesn't know what the earnings are going to be 3, 4 quarters out, a year, 2 years out. So it can't be discounted. Like the market's not efficient when it comes to super fast growth. The market is not efficient. That's why a stock can keep going and going and going and going and have this high PE, because it's not efficiently priced. When you get into something that's a slow grower and the earnings have, the visibility is very high, um, and you can pretty much figure out what those earnings are going to be 3, 4 quarters down the road. Yes, then it's efficient. The market's
Hmm.
efficient. That's why you want to go where the inefficiencies are.
Yeah. Well, to that end, let's talk about in this market, one of the things that was really kind of surprising, and again, so many speculative names. So I'm just going to throw up Rigetti as one example in the quantum computing space. There were a number of these, QBTS. You look at the chart, very powerful chart. These were almost going vertical. Most of them had like no earnings to speak of. So how much are you doing on the chart and how much are you doing on the earnings? Or do you treat these differently when you're like, okay, this is a speculative play, I'm going to do something different here? Or do you just say, no, that's too speculative, I'm not even going to play at all? How do you handle these?
I have a term that I use. It's called relative prioritizing, which means that if the technicals are strong enough, then the fundamentals they don't have a big say in my decision. Meaning
Hmm.
that if you have, in this case, you have a 99 RS, if the chart is strong, you've got a 99 RS, that's the strongest relative strength you can have. Clearly, something is going on. Something is going on, and there is an appetite for the stock, and it's outperforming virtually everything in the market. So I'm going to trust that the stock knows more than I do about the future, and I'll
Hmm.
trade that name if it meets the technical criteria, the entry criteria, all the other criteria. The earnings don't matter. Now, if maybe that's a situation where it's not as powerful, but it meets, there's a minimum criteria that I'm going to require. Then I might want to see more in the fundamentals. And it depends on the industry too. So, for instance,
Yeah.
if you're a biotech, 70, 80% of biotechs don't have earnings. So
Right.
you'd miss a lot of the great biotechs if you were looking, using earnings. So I don't generally look at the earnings for the biotechs. Um, but now, if you're looking at a turnaround situation, well, now you're going against easy comps. You're going to want very strong quarterly earnings in the most recent couple of quarters. So the first thing you have to do is kind of figure out what category the company is, and then you can decide how you're going to apply the metrics.
Hmm. Well, and I think this is important because this kind of goes to how you game plan things out. You have a process for everything, right? It's
Yeah.
if this, then this, if
Uh,
this, then this. So, if it fits in this category, here's how I'm going to treat it. And if it's in this category, I'm going to do something different. Yeah, so there's a real
I
value
mean,
to,
optimally, I want everything. I want the
yeah,
99. I want a
right.
99 relative strength stock that
Yeah.
has huge earnings in the most recent few quarters and big sales and expanding margins. That I want it all. But life's not perfect like that. You'd be missing a lot of other great opportunities too. With screening, a lot of the viewers are probably using market search to screen. You got to realize everybody's worried about having that perfect screen. They put all this stuff in their screen. The problem is if you put a lot of variables in your screen, if you miss on just one of them, it kicks the stock out. So let's
Right.
just say you have 100 things. I got the perfect screen. I'm putting everything in, throwing everything but the kitchen sink in that screen. So you put
Hmm.
100 items in there. Well, if it misses on one, 99 items are good, but because of one of the items, you're not going to see the stock.
Hmm.
So I have my screens are actually quite simple. And then I do most of the work manually, where I start looking at the earnings and the sales. And now I'm digging in and doing the homework. But
Hmm.
again, if the chart is strong enough, then I'm not worried about the earnings as much. Now, in contrast to Bill O'Neill, and I've asked Webby this, I've asked David Ryan, I've asked all the people that were closest to O'Neill, and I asked O'Neill himself. So I heard it from O'Neill, and I heard it from all the guys that worked for him. I always say, have you ever seen O'Neill buy a stock that didn't have earnings and sales? And Mike said one time, and David said never.
Yeah.
So yeah,
and I'm guessing Mike is talking about back in 2000, the Human Genome Project.
I think so.
When that was going on, there were some of those, and he got excited with everyone else. Like, hey, how can you put a price on the cure for cancer? Was his famous line.
Yeah.
So,
but even Bill, was really requiring to have the earnings on the table, the sales on the table, and really looking for to get a really perfect overall picture. And that if you're going now, here's the thing: if you're short-term trading, I've gravitated more and more to short-term trading over the years. In the beginning, we couldn't short-term trade; it wasn't even possible. You didn't have online trading, a lot of reasons, big commissions. Then over the years, as it became possible, I was able to compound more and turn over the money, turn over the portfolio. So if you're really short-term trading, well, then the fundamentals don't play nearly as much of a role. But if you're holding long-term and you're going to hold through several 2, 3, 4 quarters of earnings, and then it's a whole different story. And Bill was playing for for big moves.
Yeah.
He was looking for those really big leaders that go for secular move. And that's where you want it all on the table. Now, when you go back, you look at Bill's studies, my studies, all the studies we've done of the greatest winners, the grand majority of them, more than 2/3, 70, 80% of them, have the earnings and sales on the table before they make the big move. So you really don't have to guess. You could wait for the earnings and sales to be there, except maybe with, like I said, biotechs and certain industries.
Mm-hmm. Well, you talked a lot about the earnings, sales, all these fundamental aspects. Right now, we're in the middle of earnings season, and I mean, we've got, Meta earnings, I think, just came out, and it's down 8-9% right now, and the earnings just really can. David Ryan would call them gold mines and landmines. You're either up 20% or you're down 20%. It sometimes seems like there's very little in between. How do you go about handling earnings season, especially with your short-term trades?
Yeah, well, so overnight is where you have the big earnings risk, of course, right? You hold the stock, it reports after the close or before the open. Netflix just got whacked too, so they're starting to hit some of the stocks. Now, here's the thing you have to remember, with stocks like Nvidia, Netflix, Amazon, if you look at the institutional sponsorship, the institutional ownership, you're talking about 5,000, 7,000, 8,000 funds that own these. What that doesn't mean that the move is over, and it doesn't mean that it can't go higher. But what it does mean is there is a lot of ownership. There's a lot of potential supply. So when it does turn bad, and I tell everybody, you got to realize that some people find it hard to believe that, maybe Amazon or Nvidia or whatever name it is that's these high flyers that seem impervious to ever staying down, they will go down. They will go down 70, 80, 90%, and they will stay down for years and years and years and years, and maybe even decades, just like Microsoft did, Qualcomm, and all the high flyers in 2000. 20 years it took to get back to even. GE, these stocks were down 90%, some even more than 90%. You take a look at Nvidia. Nvidia just was down about 30% correction not long ago, and just prior to that, I think it was last year, went from
back in 2022.
I think it was 36 down to 10, which was like a 60% correction. That was within its bull market uptrend. Imagine when it tops. It went down 60% in the good time. So imagine when it actually puts in a secular top. It'll be down. The average secular leader, once it tops, goes down 70%. And it's my 50-80 rule, I call it. 50% go down 80%, 80% go down 50%. And they generally stay down for many cycles, and they're not leaders again. Sometimes never, and sometimes it takes a minimum of 5 years and usually 10 or more. But to answer
if they ever come back, right?
If they ever come back.
Yeah.
To answer your question, like how do you deal with the risk? Well, first of all, we look at implied volatility. And so if you have a stock that trades quite a bit, trades options, and it's a bigger name, you're going to get a pretty good idea of what the potential volatility is. We have a formula that we use, and then it'll tell us pretty accurately, this is going to fluctuate 10% in either direction, this is going to fluctuate 6%, and it's a pretty good guide. And if you want to be really, super risk adverse, you could double that, especially in the names that maybe don't have as good visibility, double that number, and that'll give you sort of your worst case scenario. It could be worse, but that generally speaking. So now I have to, decide if what position size, and if I want to accept that risk overnight, and that's usually the answer is no, unless I have a cushion, unless I have some cushion in the stock, or at least some cushion in the trading where I'm dealing with profits and I'm not underwater. I'm not going to start rolling the dice if I'm down, and the better I'm doing trading, the more aggressive I get. The worse I'm doing trading, the more conservative I get.
Well, and this is maybe a good time to talk about the fact that you're a lot of times doing that selling into strength so that you can free roll the trade. Maybe explain for people that aren't familiar with that strategy, what you're doing there.
I'm almost always selling into strength unless something's going wrong and stock starts coming back on me. I'll backstop sometimes and put some kind of trail behind it if I want to hold it for a bigger move. But I'm trying to get out when the getting's good and selling into strength. I want to sell it as the stock's going up, because if I sell into strength, then I'm always selling at the highest point in my own equity, so I don't have any drawdown, right? If I'm selling up into the strength, there is no equity drawdown, because once I'm out of the stock comes down, fine, but my portfolio doesn't come in because I sold into strength. So I don't have much volatility. I don't have much drawdown. And that's the secret to not having drawdown, is to sell into strength and not hold through the big gyrations. But and then again, like you said, if I have a big position and I'm going into earnings and maybe say it's up 10% and applied volatility says it's going to move 10%, well, maybe I'll sell half of it or a quarter of it, and that will give me some cushion, so to go into those earnings. And then if we get past that storm, and maybe we buy it back, but certainly, always looking at the risk side of the equation first.
Yeah. Do you ever use options to hedge a position? Or is
I
that not your
don't.
thing?
I don't. I don't use options. I think options for the 99% of the public are a complete sucker's bet. Some people can make money. We have a couple of our own members, our own clients
Right.
that do really well, but it's very rare. Yeah, I don't generally hedge either. I'm not going to hedge short one position against another. If I'm ever hedging at all, I might short the indexes against
Right.
my portfolio. Maybe I have a bunch of stocks, market's getting extended, stocks are extended. I don't want to start liquidating a bunch of names, so I'll put a short on, and I'll get sort of somewhat of a hedge by default. But usually, every position I take has to stand on its own legs.
Right.
That has to be shortable on its own. It's not just because I'm offsetting along.
And I wanted to get back to something that you mentioned, because when you're talking about the selling into strength and how that really reduces your drawdown, I'm gonna do a quick throwback, because one of the times you were on the podcast, you talked about the necessity for sacrifice. A lot of people think that they can have it both ways, right? So the other end of that, when you are reducing your drawdown, that does sometimes mean that things go up without you. How do you handle that? Because again, FOMO is real, right? A
Yeah.
lot of people really struggle with, oh, I sold into strength and it just kept going, and I wasn't in it anymore. So how do you deal with that?
Well, if you're going to let the result justify the means, and you're going to Monday morning quarterback and always look and say, I should have, I could have, I would have, you're going to have a very tough time being a stock trader and making money, because it's not what it's about, and you're not going to get the high, and that's just not what trading is about. So to me, I just want to make a lick on the stock, make more money than I risked, and do it as many times as I have to get to my goal. It doesn't really, I don't care where the stock goes. It's not an exercise in ego. It's not even an exercise in trying to get the biggest winner. It's just a matter of making more on my wins than I lose on my losers. And then it's just a matter of deciding what's on the table, where's the easy money, and how many times can you roll it over?
Mm-hmm.
So, and there's I always say this, and I think I borrowed it from Paul Tudor Jones. I can't remember at this point, but you're gonna buy stocks that go to zero, and you're gonna sell stocks that go to infinity. So
Mm-hmm.
your job as a trader is to operate in the middle of that, and to
Mm-hmm.
cut off that downside and take advantage of as much as you can on the upside. But you're never going to be able to trade that perfectly. But what you can do is trade your plan.
Yeah.
So, and that's the key. I go in with a plan, I trade my plan, and my plan is a good plan. It has an edge, and I roll that edge over as many times as I can. Some people's edge, they find it in different places, or they find it in different sizes. So somebody may be a long-term investor. Their average gain is going to be much, much larger than mine, and that means their average loss can be larger to a
Mm-hmm.
certain degree, to a certain extent, and their turnover is going to be less. Well, that's the same thing as if you've got Walmart or you've got a Ferrari dealership. Walmart
Mm-hmm.
does a lot more volume, a lot more turnover, but their margins are 1 to 3%, and they're doing a lot more business. Stock trading is just like any other business. It's just a matter of buying merchandise and selling it for a higher price than you paid for it, and doing it as many times as you can. I mean, that's what a hamburger shop wants to do, right? I have a friend. He's got a bagel shop. He could tell you the entire bagel, what the pickle cost. That's 3 cents. This is 9 cents. This is 42 cents. The bagel costs me 89 cents. I sell it for $3 or whatever, $1.89. This is what I make. I make $1. He knows it. He has it nailed down. He knows exactly how much it cost and then what he's selling it for. Now, what's the goal? Sell as many bagels as you can. Turn that thing over as many times. Every time you sell it, you're making a buck, right?
Yeah.
So that's trading. I mean,
Mm-hmm.
that's trading. That's what
Well,
people get. They get away from that focus, and they start thinking about the next Amazon.
well, and I think another important point here, Mark Ritchie II, who is one of your, proteges, when he was on the
And
podcast,
one of our coaches and one of our key people in our company.
absolutely. One of the things he was sharing last time he was on the podcast was, you know, he can't even. He's like, I can't even tell you what the S&P 500 is up for the year because
I
I'm
have no
not
idea
comparing
either.
myself to the S&P 500. I'm comparing myself to, am I executing my plan?
Yeah.
So just as your bagel shop owner knows, everything about his costs, sometimes it doesn't really help you that much to know everyone else's as
No,
well.
no, it probably will hurt you. It'll definitely
Yeah.
hurt you because it doesn't matter. It doesn't
Hmm.
matter what your friend's doing or what a fund is doing. It matters what you're doing. And
Hmm.
I can tell you right now, when things are really moving fast and I'm trading and trades are really working and I'm very aggressively, trading, I can't even tell you what I'm up for the day or what I'm up for the month.
Hmm.
I'm just the process is rolling over. I'm buying breakouts. I'm selling. So I'm just doing it, everything's moving so fast, and I'm being so aggressive. I'm really just immersed in the process. And then at the end of the day, you take a look and you see. And but I'm not really looking at that too much.
Yeah.
The performance is just a byproduct of doing the right thing.
Hmm. And since I brought up Mark Ritchie II, and you mentioned he's one of your coaches, I just want to take a moment to let people know that we've Market Surge has been an exclusive sponsor for your Master Trader Program event, and this is coming up for folks. So,
Yeah.
um, yeah, do you want to
I
talk a
think
little bit
Market
about this
Surge
event?
has been the sponsor now for I don't know maybe 8 years.
Oh
Yes,
yeah, at
and
least yeah.
Mark Ritchie is my co-instructor, and he's wonderful. David Ryan was the co-instructor for a number of years, I think maybe
Hmm.
6 years, and David Ryan was wonderful. And Mark is great too because Mark is as close to me as they come, and he's as proven with what I do because he came to the very first Master Trader program in 2010. We're on our 16th year, and Mark Ritchie came to the very first one with our other assistant on our desk, Brandon Hedgepath. They both came. Brandon sold his car to pay for it, and they ended up taking $50,000. $50,000. I'm sorry. They took
Hmm.
$50,000 and turned it into. They manage over 25 million now. And I hired him. 10 years later, he was a paying customer for 10 years for Minervini Private Access, came to the first Master Trader program and several others after, and now he's been part of the company for a number of years now, both of them, and he's my co-instructor. So I mean, it's next week, and it's coming up. Just
Yeah.
realized that. Yeah, it's coming up 8th and 9th, 15th, 17th. It's 5 days. And the workbook says 500 pages, but I think it's now over 600. I started that workbook. It was like 160 pages the first year, and then I was like, okay, well, I can't make this go higher than 200 pages, and then it went to 250. And I'm like, all right, no more than 300 pages. It's like 600 pages plus.
Yeah.
So there's a lot of material,
Yeah.
of material. It is the most comprehensive learning experience that you'll ever encounter and we've got just incredible alumni and members that have done well. The U.S. Investing, just wanted to point out real quick because Norm Zeta just asked me to do an interview with him. I just got his email today, and Norm is the founder of the U.S. Investing Championship.
Right.
And we just had the 9-month results, and it was like first, second, third, fifth, sixth, and seventh were all our customers. That, and then it's 457 people in the contest. And like 5 out of the top 6 or 6 out of the top 7 are all my clients. So we just wanted to give a shout out to everybody. What a great job, and almost every one of them came to this event.
Yeah, and we just had actually Leoš Mikulka from the Czech Republic. He was on IBD Live just this last Friday.
Leoš a great guy.
Yeah, talking about his experience, and a lot of people do talk about it being kind of like drinking from a fire hose. There's a lot of information. What would you say is kind of that difference that you see from like a Mark Ritchie who comes and sits down and watches your program, or a Leoš or some of these investing champion members? What do you think is the difference between those that take that information and really kind of run with it to have these phenomenal results?
Well, unlike sports where you need a certain degree of genetics, like some people are literally just gifted athletically, even though it doesn't necessarily make you, some of them fail, and you get people that aren't as gifted, but you do have to have some athleticism. With trading, it's really not like that. Like, you're not born, as Peter Lynch said this. As a matter of fact, one of my very good friends just met Peter Lynch on the streets of Boston the other day, and he sent me a picture with him. And it was amazing. He looked exactly the same as the cover of his book. And I don't look the same as the cover of my book. I was like, how did he do that? But some people think I lost my hair from trading, but it's actually my daughter. That's what did that. Yeah. So unlike, sports, I mean, you don't need to have certain born innate skills. It's learned. But the one thing that is the same, and it's the same with sports, it's the same with everything, is that the discipline and sticking to a process and committing to a style is what I see the difference. Mark Ritchie and Brandon are doing the same thing as they were doing 16 years ago when they came to the first Master Trader program. They left and they said, this is the way. This guy's got a way. I like this this way. I mean, Mark Ritchie's father is Mark Ritchie Sr., who was in Market Wizards. And his uncle is Joe Ritchie, who was in, I believe, the second Market Wizards, or maybe it's vice versa. It might be vice versa. Joe's in the first one, but both of his family are in the Market Wizards books. So if anybody's like genetically gifted, it might be Mark Ritchie. But then you have Brandon. Like I said, Brandon sold his car to come into the event, and by no means was wealthy, and was just a young kid. And he's amazing too. And there's so many people from all around the world. Not to mention that a lot of these people that are doing so well and win the U.S. Investing Championship aren't even in the U.S.
Right.
And they're trading the U.S. markets in other countries. Some are trading part-time while they hold jobs. So, you hear all these excuses of why you can't do it. Well, there's a lot of people that are doing really well that have, they're more handicapped, as far as their situation than maybe you are. But the one thing that I notice is they're all disciplined, and that they make a commitment to a style. They don't have style drift. When something isn't working, then they change and they change and they change and keep looking for that lottery ticket or that hot strategy. And same thing with me. I met David Ryan, Bill O'Neill in the 80s. I said, you know what, this cutting losses, buying the winners, using, strength begets strength, certain characteristics that, that I just bought into, and I never ever changed. I didn't when it didn't work for me, because I lost money for almost 6 years. I didn't make any money for 5.5 years. I didn't quit. I didn't say, okay, well, I'm going to try value. I'm going to try options. I did try options in the very, very beginning, but like I said, once I found an approach that made sense to me, I took responsibility and I dedicated myself to it and knew that I was the one that. It's like, you want to be a baseball player and you go play baseball and you get up at bat and you're going to blame the bat.
Right.
It's not the
Yeah.
bat. It's you. You're a shooting sport. And I shoot for competition. I'm going to blame the gun. People go, oh, this gun's not right. Give me the gun. I shoot it. It shoots perfect. Here, it's you. But because you're not skilled yet, you have to take time. You have to learn that particular strategy, and it takes time. It takes a lifetime to master one strategy. You're not going to master a bunch of them. I can tell you that.
Well, and I think it's also worth mentioning that, I guess one of the frustrating parts sometimes is when you make that commitment is it's not going to be working all the time, right?
No.
Strategies take turns, it's every dog has his day, and, sometimes your strategy will be out of favor. And that's where a lot of times people will give up and just say, oh, well, forget it. This strategy, it doesn't work, or it's not working. So
well, they'll say, I'll do this and I'll move back to this, but that usually isn't. That's where you should be doing your homework and post analysis and really refining things. And their downtime is important. It doesn't mean you change strategies. It means that's where you have self-reflection and a lot of other things you do. And look, if a strategy worked all the time, I'd be a trillionaire. I can assure you that. So it's long periods of time where you can lose faith and say, oh, this doesn't work anymore. But usually when you just about get convinced of that, that's where the turn comes, and everybody throws in the towel. Yeah. O'Neill said something, and I've been using it ever since, and it's the greatest. It's the greatest. One of the absolute greatest things that ever came out of anybody's mouth about trading, because it is so true. And that is, he said, while you're doing nothing, and I've paraphrased it and kind of made it added a little bit, but essentially, while you're doing nothing, less disciplined and less skilled traders are laying the foundation for your success. Those bases, those shakeouts, all that volatility that ends up turning into that nice tight buy point. Those are all trading decisions that are being made by less disciplined, less skilled, even just different strategies, and that is part of the makeup of, just like you, who you are today. Everything good and bad that happened in your life is what made you who you are today. Same things with a stock. So you've got to stay true, so that when it gets to that point where all that culminates to that buy point, you're there. You're there to see it and take advantage of it. Because you don't know when that pitch is going to come across the plate. You just have to keep staying to the process and being ready for that pitch to come across the plate.
And I think this really comes back to a point that you made earlier about that discipline. When you have that discipline to know, okay, I'm not gonna swing at anything,
Right.
And that saves you from so much trouble, right? And that's how you minimize your risks, minimize your losses, minimize your drawdowns, and all of those things that can really make such a big difference in your portfolio to the upside.
If a baseball player is getting pitches that are way outside the plate that he can barely reach with the bat, is he going to swing at it because he gets fed up, or he loses patience? Of course not. Of course, you have to wait until the pitch comes into your strike zone. This is the thing that almost every trader at some point abandons.
Mm-hmm. Yeah,
I don't abandon it. I don't. I'm religiously disciplined.
All right, and year in, year out. It's not that.
They say, how long are you going to wait? How long would you wait? How long would you sit there on your hands? How long would you wait if trades weren't working? As long as it takes. That's my answer.
Wow, that's I think a great place to end right there, Mark. Really
it's
appreciate
over?
it. It is, yeah. You know what? I mean, again, we keep it under an hour, and or actually, we're supposed to keep it under 45 minutes. But my producer is always like, when I go over 45, he's like, "Come on." Yeah. But you know what? Here's what I want to do, because a lot of times people do want kind of a stock idea. So maybe you can end with one stock idea, something that you've been looking at in particular.
Yeah, I mean, a lot of stocks are up here. I mean, Intel looks interesting on how it just got really strong here. Tesla, a lot of people are starting to talk about Tesla now. It's a big giant company handle with a very deep base, about 55, 57%. Maybe Tesla will work. Palantir, of course, is getting extended here, but it's coming out of another base. AVGO, I'm up about 30% on it. I'm actually looking to maybe sell, but a couple of names I've been looking at recently, CRDO. Reddit, maybe Reddit sets up another base. It's starting to, try to trough out here. Um, I was looking at Madrigal, but it had a bad day today, but I think it recovered. It has an interesting story there. Let's see, what else? At some point, coin and maybe Bitcoin, will set up. I would definitely be playing a setup in Bitcoin if we got a setup. Gold, I think it may go further. We're at inflation adjusted. We're at basically the $800 an ounce top. That when we topped back in 80 or around 80, whenever it was around that time. I remember that time when I was young, but I remember it. People were grabbing gold chains off of people's necks in the streets. It was like everyone was going crazy. And my friend who owned the jewelry store said it's very much like that. People are coming in selling all their gold. So I think if gold was to go higher from here, I would sell into it. But it's definitely very getting very euphoric now. So those are some names. I'm trying to see if there's anything else. Yeah, I'd say that's
That's plenty. That's plenty. So I think
yeah,
you know,
few names.
and as a reminder for folks, you have to not just take ideas that Mark throws out there and say, "Oh, well, Mark said," because as you mentioned, like with Broadcom, and I do have a position in Broadcom, you're up 30%. You might be looking at selling into strength there, whereas someone who's starting right here, while it's a perfectly good base, they're in a very different position than
Oh
you
yeah,
are with your
absolutely.
30% gain. So you have to make the trade your own and not just say, "Oh, well,
And
Mark said."
And
So
I sell early all the time, so you can't judge me. I sell stock. I took a 5 point gain off of Cisco off of the IPO base, and it went up 70,000% after that. So
right, yeah, but you did okay
I did
over time.
okay.
So I can say
I made over 700,000% on my money over a lifetime. So
so
so yeah,
perfect.
I did good trading. But yeah, so all right. Well, appreciate you having me. I hope this has been helpful for everyone, and hopefully, well, for those of you that haven't come to Master Trader Program, maybe you want to come again. We'll see you next week.
Yes, and we should mention, because again, it was on the slide, but just in case folks missed that, I'm going to share it one more time so that where do people go for information on that? For
Oh yeah.
stocktraders.com, that's the number four right here at the bottom, number four, stocktraders.com
Yeah,
is
or,
where they can
or
go.
Minervini.com too. You can go
Yeah,
there.
or Minervini.com. And hey, you're a great follow. You're always sending out a lot of great information for folks. So the at Mark Minervini on X is also a great follow there for more information, as well as your books. All of your books are definitely worth reading.
That's right.
Um,
If you can't afford to go to the Master Trader Program, or for $29 you can get a lot of information from the books, and
yeah.
they're completely homogenous with Bill's books too. I would recommend all Bill O'Neill's books,
Mhm.
um, and the Market Wizards books and my books, and you really don't need any more than that. That's
Mhm.
pretty much all you need.
Yeah.
Yeah.
And by the way, I just want to mention to you, a lot of people in the comments are saying how, yeah, they might have been a little hesitant the first time they went, but then it's like, oh, well, this is an easy decision now because they saw results. So
Hmm.
great job. And again, appreciate how much you give to people in terms of education and knowledge all the time, Mark. Really
Well,
appreciate that.
well, I love seeing people succeed, and if I can be a little part of it, that's awesome. No,
Great.
thank you for having me. I appreciate it.
Absolutely.
Yeah.
That's going to wrap it up for us this week. Thank you so much for watching. And next week, we're going to have Joe Mazzola back on the show. He is from Charles Schwab. He's their head of trading and derivatives strategies. So we often get a lot of like different option strategies from him and stuff. So it'll be great to talk with Joe again. Thank you so much for watching. Don't forget to subscribe and like on the YouTube channel, or you can always check us out at investors.com/podcast for more of those podcasts. podcast that we've been doing every week here. And hopefully we will see you next week live at 5 p.m. on Wednesday, as we typically do. Have a great weekend, everybody. Take care.